how money grows, the power of returns and compounding. Let's dive deeper into one of the most exciting parts of investing, how your money actually grows. Because here's the thing, investing isn't magic, but it feels like magic when you understand compounding. Understanding returns. Whenever you invest, you're hoping to earn a return. That's the reward for putting your money at risk. Returns can come in a few forms. Capital gains, which is when the price of your investment goes up and you sell it for more than you paid. Dividends, which are small payments companies give shareholders as a share of profits. Interest, like what you earn from bonds or savings accounts. Rental income, if you own real estate. Now, every investment has a different expected return. For example, stocks might average 7 to 10% per year long term. Bonds might give you 3 to 5%. Real estate could yield 6 to 8%, depending on the market. And crypto, well, that one can swing anywhere from minus 90% to plus 300% depending on the year. But here's the key, returns come with risk. The higher the potential reward, the more volatility, meaning your investment might go up or down in the short term. That's normal. Volatility is the price you pay for long-term growth. Simple versus compound returns. Let's talk about compounding, the ultimate growth engine. Imagine you invest $1,000 and it grows by 10% in a year. You now have $1,100. If you earn another 10% the next year, you don't just earn $100 again, you earn $110. That's because your profit from the first year also started earning profit. This interest on interest effect is what makes compounding so powerful. Albert Einstein reportedly called compounding the eighth wonder of the world. He said, "He who understands it earns it, he who doesn't pays it." Every time your money earns a return, and that return stays invested, the growth accelerates. It's why the rich get richer, not necessarily because they work harder, but because their money works smarter and longer. The compounding curve. Let's visualize it. In the beginning, growth feels slow. You might invest for a year and see only a tiny increase. But compounding has a curve. It's exponential. That means most of the growth happens later. If you invest $10,000 at 8% annual return, you'll have around $14,700 after 5 years, $21,700 after 10 years, and about $46,000 after 20 years. That's not double. That's more than 4 times your original investment. Why? Because the money you earn along the way also started earning. So when people give up after a few years because they think this isn't growing fast enough, they're quitting right before the snowball gets huge. The longer you stay invested, the steeper that curve becomes. The compounding curve. Let's visualize it. In the beginning, growth feels slow. You might invest for a year and see only a tiny increase. But compounding has a curve. It's exponential. That means most of the growth happens later. If you invest $10,000 at 8% annual return, you'll have around $14,700 after 5 years, $21,700 after 10 years, and about $46,000 after 20 years. That's not double. That's more than 4 times your original investment. Why? Because the money you earn along the way also started earning. So when people give up after a few years because they think this isn't growing fast enough, they're quitting right before the snowball gets huge. The longer you stay invested, the steeper that curve becomes. The three superpowers of compounding. Compounding has three ingredients. Time. The longer you invest, the greater the effect. Consistency. Adding money regularly keeps feeding the snowball. Reinvestment. Keeping your earnings in the system multiplies growth. Here's a simple story. Two friends, Alex and Jamie. Alex started investing $200 a month at age 25 and stops at 35. Jamie waits until 35 to start and invests the same $200 every month until 65. Who ends up with more money at 65? Surprisingly, Alex, the one who only invested for 10 years. Because Alex's early start gave compounding 30 extra years to work. That's how powerful time is. Inflation, the silent thief. While compounding helps your money grow, inflation slowly reduces what that money can buy. If inflation is 3% per year, your $100 today only has the buying power of about $74 after 10 years. That's why keeping money in cash long-term is dangerous. It guarantees loss of purchasing power. Your goal as an investor is to earn a return higher than inflation. That's what keeps your wealth growing in real terms. Reinvesting and staying the course. Now, the biggest mistake beginners make, they take profits too early. They see their investment go up 10%, they feel good, but they just stop compounding. Reinvesting your earnings, whether it's dividends, interest, or crypto staking rewards, is how you keep the growth engine running. The more often you reinvest, the faster your wealth builds. And here's another secret. The longer you stay invested, the less the short-term market swings matter. In the short term, markets are noisy. Prices move because of news, emotion, or speculation. But over decades, markets tend to reflect real growth, productivity, innovation, and value creation. That's why long-term investors win more often than short-term traders. The compounding mindset. Compounding isn't just about money, it's about habits. Every smart decision compounds over time. Learning, saving, staying consistent, all of it multiplies. Investing rewards patience and punishes panic. The most successful investors aren't the smartest or the luckiest. They're the most consistent. They keep investing through good markets and bad ones. They let time and compounding do the heavy lifting. So if you ever feel discouraged that your portfolio isn't growing fast, remember, compounding takes time to reveal its power. As Warren Buffett famously said, the stock market is a device for transferring money from the impatient to the patient. That wraps up part 2 of our guide. You now understand how money grows and why compounding is your greatest ally. In part 3, we'll explore the types of investments you can choose from: stocks, bonds, crypto, real estate, and more, and how each fits into your financial journey.